Hello, everyone. Today on the final bar, my guest is Jesse Felder from the Felder Report. Going to share a couple charts top of mind for him as we look at this S&P trying to continue, give some follow through to the upside, closing once again above the 3,600 level, but not getting above yesterday's close. So not really getting the upside buyers taking over kind of feel that you might want if you're wildly bullish, but overall certainly holding up very well at the upper end of the range. Also, some of your questions from the final bar mailbag. Ladies and gentlemen, this is the final bar. Hey everyone, welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a rainy Redmond, Washington. If you talk to anyone in the Northwest right about now, especially in the Seattle area, and they are a little grumpier than normal, I think we are entering into that period. This is my second full year that I'm starting here in this area, and the days are getting shorter and shorter. It's a nice steady rain. I don't know if you could see that out the window in the opening shot, but certainly getting to that time of year when things are darker, rainier, a little quieter. So but where there are bright spots is in the markets. So the S&P certainly, not breaking down by any means, but not following through to the upside. Sort of a choppy mid-range day today, and you had energy leading the way higher. Everything else was sort of flat to down, with utilities down 2% on the same day. So sort of a mixed bag of things, but some little nuggets of signal in there. And I think in particular, when you look at the breadth charts, I've been thinking a lot about sentiment recently. We've been talking about the euphoric sentiment conditions, which I think are certainly prevalent, but the breadth ratings are just incredibly positive when you look at certain charts. We're going to try to hit a couple of those a little later in the show. Now we have some wonderful guests coming through the final bar. Today, Jesse Felder, I'm really excited to have him back on the show after coming last back in August. Tomorrow on the 18th, we have Joe Duarte. And on Thursday, Mark Young from Wall Street Sentiment. Then very quickly, next Tuesday on the 24th, we have T.G. Watkins from Simpler Trading joining us for the first time. He's done a couple of slots on Your Daily 5 that have gone very well, so excited to hear his take on the show. A couple other quick comments for you. Number one, if you could do me a favor, go to our StockCharts TV page, stockcharts.com/TV. We have a survey running at the top of the screen. We would love to get as much feedback as we can. We're sort of sketching out the beginning of next year. We're working on a lot of really cool programming for year end and to announce the beginning of 2021. But we're thinking about how we can improve the channel, improve the content, improve the hosts. So selfishly, we'd love to get feedback on myself and others. So please do me a favor, go to the StockCharts TV page and fill out that quick survey, give us some feedback. Also, I'll be speaking at the Money Show this week on Thursday the 19th at 2:40 p.m. Eastern, giving a presentation called 7 Bull Market Mistakes and How to Avoid Them. I did a presentation earlier this year on 7 bear market mistakes, and I thought it was appropriate to sort of flip that and focus on what we tend to do when the market's at or near all-time highs, some of the mistakes we can make and how to address those. So check that out if you could. Let's get to our market recap. So as I mentioned, I think the 3 goals of a trend following investor, of a momentum investor, is number 1, identify the trends. Number 2, follow the trends. And number 3, anticipate when those trends are exhausted. And I think if you look at the first 2, identifying the trends and following the trends, clearly the trend has been positive. And if you look at the weekly trend model that we follow pretty regularly, long-term, medium-term, short-term, it's all based on the weekly chart, but across the board, running positive. And shows you the strength of the trend that we've seen, certainly at the upper end of this range and potentially breaking out right now. And certainly the emergence of some of the leadership spaces like industrials, materials, financials, energy, all kind of coming on pretty strong here in the last week or two. Certainly speaking to the strength of the market, the resilience of the market, especially in places like mid and small caps, especially small caps, which we kind of been underperforming for quite a while. But that third one is the interesting one. This is where I think you can get some potential bearish indications, or looking at sentiment readings. We talked about the euphoria that we're seeing in things like the AAII survey at an extreme bullish reading for the first time in quite a long time. So I think there's that balance. As a trend follower, you have to acknowledge the fact that the trend is positive. As a contrarian, if I put on the Humphrey Neal contrarian hat, I'm seeing things that tell me that we've gotten too euphoric and to expect some sort of pullback. But what's most important is price. Price is number one. So what happened with the S&P today? Well, if you look at the S&P chart, you're going to see a doji candle, which is basically the open and close right about at the same point, and then you have the stem, the middle, the shadow, if you will, that shows you the high to low range. That tends to be a short-term reversal signal. Looking at candle patterns on the S&P itself sometimes is not as ideal, because a lot of times you get some interesting readings just because the open is a little different for an index like that. So maybe look at the futures or the SPY and see if you get a similar sort of pattern. But for what it's worth, that's what we're seeing. I think more interestingly, we had the breakout finally closing above 3,600 for the first time yesterday. We didn't follow through any further, and so the very simple measure I would use is you want to close to a higher high. If not close, you want to at least move above the previous day's highs. We haven't done that yet, so we're not getting that follow through yet, that confirmation that yesterday's breakout was the beginning of something more. I think at this point I'm looking at being at the upper end of the range, being in this green shaded area, seeing the sentiment at extremes, and assuming or expecting we're at the upper end of some sort of channel, and we have to back and fill and go further down here. It is interesting to look at some of the momentum readings, and on some of the individual price charts, you'll see where there's a clear bearish divergence. I don't think you really get that on the S&P just yet, because we're still sort of at the upper end of this range. But if we would pull back, especially on the weekly chart, you get a bit of a bearish divergence there for what it's worth. But overall, again, the trend on any time frame has been positive, and that is certainly noteworthy. When I'm thinking of the breadth conditions, I mentioned the strength, and this is the chart that I have in the back of my mind. This is the S&P with the breadth by cap tiers, and these are very subjectively color coded by myself. Usually over the weekend, I'll update the colors. I kept them orange for the NYSE common stock breadth line and for the small cap advanced decline line, because they hadn't really followed through. They'd broken above their August and October highs, but had come back down, and on Friday they were back below it. What's happened since then, though, is they've all reversed course. And while the S&P advanced decline line has already made new highs, the mid-cap AD line has already made new highs. Now, as of yesterday's close, we see the small cap breadth line, the common stock only breadth line, all confirming new highs. So essentially what that is suggesting is overall breadth is strong, overall participation is good, overall the market is in healthy shape from a bottom-up perspective, is essentially what that's telling me. So again, as a trend follower, I'm assuming the trend is going to go up until told otherwise. And what happens now, besides assuming the trend goes higher, is you look for signals that we might start to reverse. That's where the sentiment read for me just starts to be something I think about more. Let's look at some other signals just across the board, and we'll hit a couple of the charts here before we get to the break. S&P finishing down 0.5%, so just below 3610. It was close to regaining yesterday's close, but sort of pulled back within the last hour. Mid caps flat to up, small caps the best of the three, up 0.5%. Again, we've had this trend of small cap outperforming. If you look at the ratio of the IWM versus the SPY, certainly has been back to favoring small caps in the last couple of weeks. And that is quite a sea change from what we had seen before. The VIX back up, by the way, just above 2275. Looking at bond markets, the TLT was up about 0.6% to 150s, below 159. 10-year yields back down, still pretty elevated relative to the trend over recent months. Looking at commodities, energy was the number one S&P sector, up 1%. Oil was up a little bit. Gold and silver, sort of the metals trade, was weaker, and that really accelerated to the downside in the last hour as well. So you kind of had a certain theme happening until about 3:15 Eastern, and then things are really started to fluctuate. Gold and metals selling off, stocks selling off going into the close. Looking at the sector themes, we've talked about this reemergence of the value trade, and looking at sectors like energy, like financials, like industrials. The XLE chart is really fascinating. It's amazing how quickly this has gone from one of the ugliest charts I've ever seen to one of the much less uglier charts that I've ever seen. We talked about this. Yeah, and I feel like once a week I would do my normal routine of bringing up the XLE and reminding people don't touch something that's been underperforming and in a clear downtrend for so long. That totally changed when you had the gap higher. And I think, at that point you immediately put the lower end just above 32 as your, mental stop or your actual stop, and you see if we can remain above there. What's now happened is we've propelled even higher. So we've finally broken above this trend line that seemed, unreachable a couple weeks ago, which was taking the January to June highs, connecting that to where we're at. We've now broken above it. We've now broken above the 200-day moving average, closed above it yesterday for the first time since January, and then followed through that to the upside. And now we're at sort of that last line in the sand we mentioned yesterday, which is the 38.2% retracement. If and when we break that, which certainly seems reasonable, we will do. I think that's upside to 46, right, which is the peak from June. There's a lot of open space on this chart that really hasn't been filled in because of the accelerated down move and sort of the choppy nature afterwards. So energy really, appearing to set up pretty well for further upside. And again, what's great about those gaps as we move higher is it gives you some clear lines below there to focus on. Having said that, I think there's a great symmetry in the financial sector. If you look at the XLF, the peak from June has now become the low from last week. I think we remain above 2650 on the XLF, and the sector's in pretty decent shape. If you look at a lot of the names in there, we might bring up JP Morgan here in a little bit if we have time for it. You'll see some of the bank charts, especially regional banks, going down to like Key and others, setting up in a pretty positive way. And they've rotated from sort of stagnant flat to down to being certainly much more constructive charts. So plenty of opportunities there, especially in some of these sectors that have been relatively unloved. So I'd encourage you to broaden out your screening, your scanning a little bit, and look for opportunities outside of things like tech and consumer, where we've been very focused for many months leading up through today. We need to take a quick commercial break. Back with my guest, Jesse Felder. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. As a reminder, we're going to do another mailbag segment a little later in today's show. We would love to answer one of your questions on our next mailbag segment at the end of the week. You can get your questions to us three ways. One is via email, thefinalbar@StockCharts.com. Number two, on Twitter @FinalBarSCTV. Finally, on our YouTube channel, just put a comment below the show you're watching. We'll capture all of those, and questions we're going to review today have come from each one of those sources, sort of a mix of sources. So please keep your questions coming. We love to hear from you, particularly questions that come up as you're analyzing your charts in your own process. I want to welcome on my guest back to the show, Jesse Felder, founder of the Felder Report. Jesse, you were on the show back in August. You did a great job talking about a weaker dollar environment. I don't know if you remember that discussion, but it was fantastic and played out pretty well. So very eager to hear what you're seeing these days. Welcome back to the show.
Hey, thanks for having me, Dave. I think we may see a dollar rally in this short run, but this first chart that I've shared with you is, I think it highlights, to me, the most important dynamic in the market right now, and that's the value versus growth trade. Growth has, dramatically outperformed value this year until the past, couple of weeks. I think with the vaccine announcements, we've seen value start to come back. But I put on the chart here the 30-year Treasury yield too, because they seem to have a tight correlation, and that would just basically tie into the fact that people view growth stocks as long duration assets and value stocks as short duration assets. So, long bonds and growth should perform relatively similarly. The thing I would highlight here is that the 30-year yield is essentially back to where it was in late February, but growth, or this value to growth ratio, is still far lower than it was back in February. So this reversion in the two is only potentially just begun. And if it were to, I think, catch back up with 30-year yields, it would have to rise, 20% or so. So I do think that the value to growth trade is probably just in its early innings. The next trade that I share, or chart that I shared with you, Dave, is this chart of the energy versus the S&P 500. And to me, this is probably the epitome of the value trade right now. To me, the only, as a longtime value investor, the only real sector in the market that is truly absolutely cheap is energy. And energy, relative to the S&P, typically trades in line with the oil price. So oil prices are rising, and energy stocks usually outperform to the upside. and vice versa. What we've seen is the oil price, bottomed back there in April and has rallied pretty strongly, but value stocks energy relative to the S&P went on to make a new low. And that is a massive divergence, which to me shows energy stocks still have a ton of potential upside relative to the S&P 500. They to me are the most attractive part of the whole value trade if you're looking at value stocks. But I think one part of this, and this would be the final chart that maybe a lot of people aren't talking about, is I do believe this value outperformance is sustainable, but I do think it could come more from a decline in growth stocks than a real upside to value stocks. A lot of value stocks are not cheap in absolute terms. They're cheap relative to growth, but growth is extremely overpriced. And to me, you were talking about sentiment there, and this is one of those charts that I pay close attention to that highlights this. Ridex traders have gotten extremely bullish once again in the last couple of months. The only times in the past few years they've gotten as bullish as they are today, or this was as of last week, was late last year, just a couple months before the big decline. Back in the fall of 2018 and then early 2018. And that early 2018 crash was kind of the Volmageddon mini crash. But then we had a pretty steep decline in late 2018. So this to me suggests that, like you were pointing out, traders have probably gotten too bullish on the big popular stocks, S&P 500, NASDAQ 100, most importantly to me. So I think probably value can continue to outperform, but it may outperform as a function of losing less in a decline.
That's such a great take, Jesse, and I love that. I think a lot of times when we think about ratios, we immediately relate that to absolute movement. But you're right; they can outperform, but still be going down in some way. And it's so funny. I think this second chart is fantastic. So I remember years ago when as a technical analyst, you're asked to think about the energy sector, and my answer would be just look at oil. I figure out what oil is going to do, and there's your call. But it's been completely unwound here in the last 6 months, right?
Yeah, I mean, this has totally come apart, and this is to me a function of just how hated the energy sector has gotten. I've been pounding the table bullish on energy for the past month or 6 weeks. Did an interesting podcast with Lee Gehring, who to me is one of the preeminent thinkers in this space. And the supply-demand dynamic for energy is a lot better than people have thought that it looks for the oil price. And then when you look at what's really been driving energy stocks is the popularity of ESG has really, if you think of, is there one sector that's been shunned by ESG, it's energy. I can't think of another sector that's been entirely shunned by probably the most popular single kind of passive investing strategy we've seen over the last 18 months, 2 years. And so these stocks have been absolutely left for dead. To me, they're really reminiscent of gold and the gold miners in late 2015.
Sure.
They're just terrific value. And now the technicals are really starting to turn in a positive way.
That's a great take. 3 great charts. And Jesse, appreciate so much you coming back on the show, sharing us some comments with us. Hope you and those around you stay safe, and we'll talk to you again soon. All right.
Thanks, Dave. Always a pleasure to be with you.
That's Jesse Felder, founder of the Felder Report. And again, I'm always humbled when someone comes on who I feel like knows and uses the StockCharts platform better than I do. And Jesse is one of those. He brings up charts and I'm making notes like, oh, that's a great way to show that. It's a really good visualization, simple, but tells a great message. So some really interesting themes in there, sort of that, that reversion with value versus growth, looking at energy and where it's at relative to oil prices and the extremes in sentiment that we've been highlighting as well. We need to move on with the Final Bar mailbag, answering some of your questions that you sent in recently. And again, these questions that I selected for today have really come from each one of those methods: emailing, tagging on Twitter, and putting a comment on YouTube. So please keep them coming. We'd love to hear from you and answer as much as we can to help you on your journey of market awareness. Question number 1 is a wordy one, so I'm going to summarize a little bit. Let's see, like me and others, maybe including yourself, are others trading Bitcoin and altcoins on the side? You're doing your regular analysis, but then trading Bitcoin and altcoins on the side. So my answer to that, and you had a long question. I'm summarizing it a great deal, but the question was trading Bitcoin and altcoins. So the short answer is no, I don't do any of that, especially short-term trading. I'm really not a short-term trader, and I found, and I'll tell you why, and maybe this is why I thought it was a great question to address. If you're going to be trading something like Bitcoins or cryptocurrencies, and you're going to be doing it on a short-term basis, which arguably makes a ton of sense, because the argument for that is is Bitcoin and other cryptocurrencies, because there's such a lack of fundamental data. There's very little and very, very little prevalent information I've seen that really justifies the value for Bitcoin based on some fundamental metric. It's much more of a pure petri dish of investor behavior, and you have a lot of new participants, a lot of arguably uninformed or definitely inexperienced investors, and that again, well, that's not a bad thing. That just tells you that it is a ripe environment for charting, for technical analysis. And I think that's absolutely the case. But if you're going to be trading, if you're trying to identify price swings, for me, that means the more short-term you are and the more active you want to be, the more of your attention and your energy it requires. And I don't have enough to focus and do that well, so I choose not to do so. I should disclose GBTC, which is one of the Bitcoin trusts. I do hold that in a retirement account, but nothing, certainly not actively. Having said that, again, I think my point is, trading something more actively means you need to have more of a commitment to following it closely and taking an active interest in what you're doing. So if you can develop that sort of time, I wish you the best and good luck. I think it's a ripe environment given the lack of fundamental data. Question 2, what are your thoughts on the Tesla inclusion and allocation requirements being enough to overcome elevated sentiment in the SPX? Decent question. I think, the news with Tesla going into the S&P, and it's not, so the news obviously hit, it's not actually taking effect until, late December, I think about a month out, if I remember right. So gapped higher, still closed up pretty good, but sold off going into the afternoon. So overall, what does that mean? I would say, so one thing, I think the chart of Tesla overall has been, relatively range bound. If you think of the S&P that's rallied up into this recent peak and now sort of chopping around, this is, the chart of Tesla is lower highs and higher lows. It's in this huge consolidation pattern. Unfortunately, the range of it is massive. It's going from 500 at the top to 325 at the bottom, and it's sort of still in the middle of that range with a flat 50-day moving average. So I think it's chopped around a great deal. I don't really get a clear sense of the direction of where we're going. The big move out of the open today kind of coming back and settling down. Certainly the idea that it's including the S&P tends to be a positive thing for a stock, and that has been the skepticism surrounding Tesla maybe alleviated a little bit by the fact that it's in some way validated by including the S&P. I think the main reason I wanted to include your question, and thank you for that, was to remind people that we often think of the S&P 500, the Dow, as the static group of stocks and just how the index has done. If you look at the membership in the Dow or the S&P, the further you go back left on the chart, the less and less connected those companies are to the companies that are in there now. So it is not a continuous group of stocks. It is not a, one basket and you're seeing how they fluctuate. It changes. And so there's a survivorship bias baked into these indexes, because stocks that don't do well and stocks that get small kind of get taken out of the indexes, and things that are doing better get put into them. So there's sort of a natural growthiness to the whole indexing process, which is probably more than most people care about, but I know it's something at times I've spent a lot of time thinking about. Next chart, could technical analysis on SDS, DXD, and QID help pick an exhaustion top on the spiders, the diamonds, and the Qs? It's a really interesting question, actually. So you're talking about the sort of leverage short ETFs, right? So the SDS is the double short S&P, the DXD, which I'm showing here, is the ultra short Dow index. So, could you do that? Absolutely. Certainly could. And I think when I'm looking at the DXD, it was oversold here in June at the market peak. It was oversold here in September, really late August before the bounce here. It is not quite oversold, but really close to that. And I think that is fair to look at. For me, I think with the leveraged ETFs, I use them very rarely for analysis. I have used them as investment vehicles, but it's more making the analysis on the underlying. Here's what I think of the S&P. Okay, I think it's going down. Then the SDS would be a way to, to communicate that in a portfolio, right? To position myself for the market going lower. Just like you would use options, I don't think you should use technical analysis a lot on a particular options contract. You use it on the underlying and then develop an option strategy that helps you take advantage of the probable direction that you're identifying. So I don't use it a lot for analysis. I would certainly, if you know what you're doing and you understand the decay that's baked into these, you understand the time factor and all of that, I think they're totally legitimate to use. In general, remember, the longer you hold a short ETF or a leveraged ETF, the less and less connected it is to the price of the underlying because of how it's calculated on daily returns. Next question. I was horrified recently to learn my chart platform just subtracts the values and doesn't divide them for a ratio like StockCharts. If I wanted to calculate the MACD of a ratio manually, how would I do that? Boy, I hope that's not something you ever feel the need to do, but I will. This question cracks me up because when I first was learning technical analysis, I was at Bloomberg. This is in 2000, 2001, and I wanted to learn more about technical analysis. And a mentor of mine said, okay, first, what you're going to do is go through every technical indicator we have and create an Excel sheet that proves out why the number is what it was. So I literally did that. So I remember building MACD in a spreadsheet, same with RSI and DMI and ADX and all of these things. And I learned a ton from it. So maybe there is some benefit to doing that. We do have a chart school article that tells you how to calculate an exponential moving average. That's the really tough part. So if you look for the chart school article called Moving Averages, Simple and Exponential, go down a little bit, you'll see exponential moving average calculation. I will tell you the starting point is really crucial, and as far back as you can start is kind of important because the longer data you have, an exponential calculation basically has the same start point, just keeps adding additional data. So the starting point is going to affect your results. That one might look different from what you see on StockCharts. It's all about where you start the calculation. And then MACD is just taking a couple EMAs and subtracting one from the other. We have a chart school article on MACD, which explains what that is and how it works. That's all the time we have for questions. We'll hopefully get to many more in our next mailbag segment on Friday. So please keep them coming and we'll answer as many as we can. We need to wrap the show and go to the 3 and 3 charts in 3 minutes. Here we go. Chart number 1 is the S&P breadth by cap tiers. We looked at a version of this a little earlier in the show, and I just wanted to reiterate again, for me, the goal of a trend following investor, this is something that Chip Anderson, the founder of StockCharts, mentioned in an interview a while ago, and I thought it was just beautifully explained. You have 3 goals. Number 1, identify the trends. Number 2, follow the trends. Number 3, anticipate when the trends might be reversing, and that is the game. And so those first 2, identifying the trends and following the trends, that's where this chart of breadth certainly speaks to me and tells you about the trend. Where are we at up until this moment? Because the assumption overall is that trends are most likely going to continue until proven otherwise, until some extraneous factor or something causes a change in the trend. These are firing on all cylinders by this current read, with all 4 advanced decline lines breaking to new swing highs, eclipsing the August and October highs. So I have to say, from a price and breadth perspective, trend is positive. Now, what does this mean for some particular names? 2 that I'll highlight. I thought Jesse Felder's comments were fantastic, and I agree with his, with his sentiment for the most part. Absolutely, especially just talking about some of the underappreciated sectors starting to certainly work. And I think we looked at the chart of the XLF earlier. I mentioned JP Morgan. I think what's interesting on a chart like this, I love the symmetry of the break to the 200-day moving average in June. It was repelled. It came back down. We broke above that finally here in early, mid-October, early November. We then gapped higher right above that June peak. And now that has become support. That was the pullback later. And that traditional pattern of a breakout above resistance, a test of support, and then the next big leg higher has been seen by chartists for decades, if not centuries. So it's certainly the base case, I would assume, on something like JP Morgan. To break below 112.50 would tell me that is incorrect, and to think about the potential for further downside. Also, I have to mention, obviously being in Washington State, Boeing, which is obviously a huge employer in the area. It's an area of a lot of focus, or a company that it's certainly under the microscope in the Seattle area. Also similar to the chart of JP Morgan, a little different that it hasn't gotten to its June peak yet, which is why on this chart, I think that's a really clear line in the sand That's just above like the 230 range or so. That was the high close back in June. So that's certainly where I'll be looking for the next level of resistance. But interesting to note that Boeing's back above its 200-day for the first time since late 2019, and following through to the upside in the last couple of days. Overbought, but overall pretty strong uptrend with potential for further upside. Folks, that is our show for today. Thank you so much for joining me. Special thank you to Jesse Felder joining us from Oregon with his thoughts on the market environment. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.